Hello and welcome to Trading Blows from TraderX, the show where we put three experienced market participants head to head, discussing and debating a range of key topics and scoring points for brilliant answers. On today's show, we've got plenty to discuss. The central bank bonanza rolls on with decisions due from the ECB and the Bank of England. We look ahead to Friday's US labour market report and also take a look at earnings and how they may impact the bull run that equity markets have been on to start 2023. Without further ado, let's get into things. Well, it only took two takes to get that intro right, so I suppose that's not too bad in the grand scheme of things, but let's not dwell on that for too long because we've got a big show ahead and plenty to discuss. So let's meet our panellists. Joining us today, we've got Arno, market analyst for Financial Source. We've also got Ryan Paisey, the founder of PIQ Suite, who is wearing a rather dodgy red hat to cover up an even dodgier haircut underneath there. And we've also got Adam Linton, who is the head of the European desk at Newsquawk, who has been, well, in my ear all morning and is now on the show with us. Gents, good afternoon. How are you doing?
Hello. I'm all right. I'd like to make it very apparent to everyone that the only reason the hat's being put on is because apparently people at Pepperstone Towers and TraderX Towers had mugged me off. So I just want to get that clear.
The haircut was shocking, so it is for the good of everyone that the hat is on. Arno, welcome to the show. How are things down in South Africa?
Well, I have power at the moment, so it's going incredibly well.
So far. Brilliant. Well, before Arno loses power, let's get into round one. Right, the ECB, not necessarily everyone's favourite central bank, but certainly one that is on the radar at the moment, and I would argue probably the most determined among the G10 central banks to raise rates and tighten policy. The guidance they gave in December was very clear. We're going to get 50 basis points worth of hikes in February, and we're going to get another 50 basis point rise in March. So, Adam, what do you think? Does that really give much room for policymakers to surprise on Thursday, or is this all going to be a little bit of a non-event?
I think in terms of kind of the top line decision, given how markets are priced for 50 basis points, I don't think we can see much in the way of surprises there. I think in terms of the accompanying policy statement, markets will be looking for the ECB to kind of reaffirm that rates will rise at a significant and steady pace. And if that is the case, there'll be an endorsement of another 50 basis points to follow in March. We'll get some technical details on the asset purchase program reinvestments, but ultimately, it's not likely to be too much of a game changer for European assets. I think, as always, the magic for the ECB often comes at the press conference. So any potential kind of slip-ups from Lagarde will be jumped on. We're looking to see if she's explicit about another 50 basis points in March. Then ultimately, given that the March meeting will have macro projections, the upcoming one won't. She may just defer until March. And I think that'll be kind of a bit more of an interest for the market. And in terms of kind of further throughout the year, we are looking for potential rate cuts later on in the year, but I don't think that's necessarily going to be a topic of discussion.
Well, hold that thought. We'll get onto that in a moment. Someone's clearly done their homework with that answer.
Yeah,
Ryan, do you agree with what Adam's had to say there?
So I agree that it's the March meeting is the most important. I think March 16th. I know, this not wish our lives away, and we're only hitting February now, but and it's a good month away yet. But you got Feb CPI released on the 2nd of March, and you got the import price data on the 7th of March, and then you've got the ECB meeting on the 16th. I think those two, the CPI and import prices data, are far enough in front to kind of really kind of twist the knife, so to speak, or would you have a big impact, should we say, on the March meeting? Feels a bit odd that we're kind of focusing on the March meeting rather than Feb, which is tomorrow. But then, as Adam said, 50 hike to 2.5% is nailed on. I don't believe we'll be seeing 50 basis points next month in March, because when you look at today's CPI data, it's kind of coming off the boil. The inflation print, as we call it, or if you're looking at monthly data, it's more the deflation print, because we had a negative 0.4% release on that. I think as well, it's important to realise one of my favourite sayings, as we all know, is headline.
Take gun to your head.
Pardon?
Oh, you weren't going to say it. I was going to say last week's show, if I had a gun to my head, I was getting slightly worried for your safety last week.
No. So headline for show, core for dough. I think, it's now, everyone's now should be focusing on core CPI prints, which will lead through to the rest. Just a quick one on if you wanted do you want me to give you a trade now, or do you want me to wait until after?
We'll come back to that in a second, because I want to bring Arno in for a second, because the point you made on core CPI, I think, is a really important one, because you've got this divergence, and it's not just in the Eurozone. It's happening all over the place, where headline prices are rolling over quite nicely, but core prices are remaining elevated and really, really stubbornly high. And Arno, what do you think? Do you think that's going to lead to the ECB perhaps being a lot more hawkish than we expect for a lot longer than the market price is in?
Yeah, it's at this stage, I think the markets themselves have gotten a little bit ahead of themselves in terms of what the ECB will do. And part of it is the ECB's fault, I think. If you think back just 6 weeks ago, when you read all of the year-end or full-year reports, everybody was looking for euro-dollar to go closer back to parity, and for the Eurozone to get some sort of a recession. And we're 6 weeks on, and now everybody's expecting euro-dollar to go back to 115 and 120, and for the Eurozone recession to be averted. Now, I think a lot of that has been down to gas prices, which has been positive, and that is something that the ECB would obviously like. But I also think it's because of the soft data that we've had. And I think the markets is potentially focusing on the wrong thing, because there's a divergence between the soft data and the hard data, right? The soft data, like the PMIs, looking at sentiment measures, confidence measures, all of those things have definitely improved, no doubt. But we need to understand, when we interpret that, we first need to look at where we're coming from. And 3 months ago, everybody was still expecting Eurozone to go into a massively deep recession. Now, 3 months on, everybody's expecting that to be a very, very shallow growth profile. So when you look at sentiment measures or confidence measures, which a lot of this hyped up speculation is based on, you need to understand that going from expecting the worst to just expecting flat, that's why we're seeing that pickup. So the danger here is that the markets is front running the ECB to do something that the hard data might not back them up to do. So if you take a look at the hard data this week, which everybody ignored, is looking at Germany coming in with a contraction of negative 0.4. France came in at 0.1. Total Eurozone came in at 0.1 as well. That's not something to be, super excited about at this stage. Growth is definitely still a problem. So what I think has happened here is the markets have front run that, and it's partly the ECB's fault, because they had a chance 2 weeks ago to tame things down a bit, because we had that sources piece, you guys will recall, where they said they could potentially go 25 in March, but they just had to double down, right? They just had to say, no, 50 Feb, 50 March, 50 Feb, 50 March. Now, the markets have priced that in. The euro is very stretched versus the dollar if you're looking at the open interest on a 12-month basis. And I think the risk is that the ECB delivers this 50, but, siding with what Ryan says, I'm not sure whether they go ahead with that 50 in March as well, because at the end of the day, the data will tell us what's going to happen. Also, and that's the biggest risk right now.
Arno, what's your opinion on this lack of, I was going to say German CPI data, but lack of CPI data? Do you think? I think it's
made. Yeah, I think because if you look at the weighting, 25%, it's. I wouldn't trust this week's HIC data.
Yeah, perfect. Yeah. I think if we see on the same page there.
Yeah, if we see to next week's data, sorry.
I would push back on this note. I would push back on the notion of a potential step down to March, because I think for once the ECB comms effort was so kind of in unison after that report came out. And I think it's more of a credibility issue for the ECB at this stage, where they kind of deliver 50. They got stuck, one second. They got stung last year when they didn't hike by 25, and they should have done, and they kind of were late to the party for credibility issues to preserve their sequencing. So I think there's always a lot more of a political kind of credibility decision with the ECB. But if they do pull 50 in March, then it may just be the consequence.
Sorry,
we just get
saying
to
that they've
quicker.
got to go to 50 in March because they've already said so? Is that the base, the TLDR of what you said? But the thing. Yeah,
I think that is part of the
no,
reason, because also as well, they know that other central banks are going to be pausing and then potentially cutting, so they're going to want to front load
just because
getting their decisions in anyway.
Hike in March, no one's going to hold them to that if that's the case, because there's so much data between when it was said. If anything, they'll lose more credibility if the data goes against that, and they feel like Biden to do it. I
think that's a good point.
But they've done it before. They've done it before.
I think that's a good point.
Past performance and all that, but they would get a lot more hatred from the punters if they hiked 50 in the face of weakening data, just because they said in December, January that they were going to do it. It's like, you got, as we keep saying, as everyone keeps suggesting, as the central bankers word for word tell us, data dependency. So we love a bit of forward guidance, of course we do, because it makes our lives a bit easier. But at the same time, we all understand that no one is beholden to forward guidance if the market completely changes in the meantime, or else you just that's when you lose credibility. But
it pays. Sorry,
if we're near terminal, I'd agree, but because they've got so much room to go, they still have scope just to do 50 if they want to, because they're not going to be at terminal either way.
About that terminal rate being nailed on as well. Maybe the fifth, maybe there's only extra 75 points in it before we should be hitting terminal. I'm not what the market's pricing in 100 basis points worth of tightening between now and July, roughly, or whatever it was. I think
it's around that figure. I'm sorry, gents. I'm going to have to step in there, because I was under very strict instructions that we can't run over half an hour, and I fear that we could talk about the ECB all day. So before we finish up the round, just a one-word answer from each of you. Which way do you think the balance of risks is tilted for the euro going into the ECB? Is it towards 110 on euro dollar, or do we like to see the common currency take a leg lower? Let's go left to right. Arno first.
Lower.
Ryan?
Lower.
Ads?
Yeah.
It's suddenly turned into
everyone buy euro.
Without further ado, then, now that the ECB is discussed at length, let's move on to the old lady of Threadneedle Street. So, the Bank of England, I would usually say just down the road, but it's not, because I'm stuck at home today because of the train strikes. Just down the road from Adam is the Bank of England, of course, and we've also got a decision due from the BOE on Thursday. In quite some contrast to the ECB, the Bank of England have probably been one of the most reluctant G10 central banks to tighten policy. They've almost had to be dragged kicking and screaming to bring rates higher, and actually the MPC, as we saw at the December meeting, bitterly divided with two policymakers voting for rates to remain unchanged. Of course, expectations are for another 50 basis point move this time around. I think it's pretty much nailed on, although, of course, you never really know with the Bank of England these days. I guess the real question is, how close to the end of the tightening cycle are we with the BOE, and how close are we to the doves on the MPC actually wrestling control of things and bringing this tightening cycle to an end sooner rather than later? Ryan, I'm sure you've got some opinions on what the bank are doing.
I have, but not necessarily on the Bank of England, but I'm full of opinions. So as you said, hike 50 to 4%. It'll be the 10th in a row, believe it or not. Probably keeps old Tem Ray roll, said in a Scooby-Doo voice, awake at night. Terminal rate all but achieved, in my opinion. I think everyone's suggesting that we're going to see the last of the forceful hikes this time. When you look at UK business activity, disappointing, Christmas retail sales in the toilet. I think if they could, they'd be cutting now, but they obviously can't. I'd be shocked if we see north of 4.25% in the coming months. I don't fancy being long cable right now because of this. I've got to be honest. My dovish surprise spider sense is tingling, or it might be some other sort of rash. I'm not really sure. They will hike 50. I don't think they want to hike 50, and this will be the last 50 that we get. That's my very quick to the point.
Yes, I think most of us would agree with that. Adam, let's go to you specifically on the growth angle. As Ryan said, the consumer is weakening very, very rapidly indeed. The December retail sales print was pretty grim indeed. Obviously, you had the IMF out earlier this week saying the UK economy will be the only G7 to experience a contraction this year. Yes, I would take that with a huge pinch of salt. But do you reckon that the bank are going to give another relatively grim view in terms of economic performance over the next few quarters?
So in terms of the grim view, so obviously that'd be an update to the November MPR, which looks for a 2023 growth contraction of 1.5%. Obviously, the context of that was the survey forecasts were taken in the fallout of the trust turmoil, or what the use of alliteration
well,
you like. So they're just outrightly kind of downbeat.
I think point for long words is very much biased against me, I'm afraid.
So an upgrade is inevitable, and we saw the November month-on-month GDP that was better than expected. So in order to kind of contract into Q4, then we'd need to see something at negative 0.4% for December, which would be above the Bank of England's forecast. So I think an upgrade is definitely on the cards there. So I think we could potentially get something in the line of potential from minus 1.5 to around minus 0.5, which would put it kind of a little bit above, but ultimately in the vicinity of the IMF. I think the people that kind of mainly care about these forecasts are more kind of like the mainstream media and kind of the journalists, whether it's kind of minus 0.6 or minus 0.4 isn't really going to make too much of a difference. I think obviously the growth outlook is particularly tricky here for the inflation outlook. And the reason why these forecasts get so much focus is they measure them to other G10 peers. But in terms of actual market perspective, I don't think on the day the growth projection is going to be the takeaway. I think it's the divisive nature of the rate decision, which can be important, on which I would like to flag that I think there's a more likely chance of 25 basis points than the market is giving credence to. Because if you think of the kind of mechanics on the MPC, so we're looking for unchanged for Tenraya and Dingra, you'd assume the more hawkish members go for 50 basis points. There's what I like to call a moderate space for a safe space for moderate MPC members, where 25 basis points kind of puts you in between the two if you kind of don't want to rock the boat either way. So I think that kind of be the main focus for the day. Growth projections are important.
I think that's a really good point, actually. And as you say...
Sorry, just before... Can I just make a quick point that it kind of just got reminded of? And I believe I would be surprised if many people that are watching this know of this, but when we associate GDP numbers, we naturally think that it's a stable GDP across everywhere. Everyone that reports a GDP figure, we all assume it's based on the same data. It's not. Every country creates their GDP figure slightly separately. It means, I'm not saying it's having any impact here, but it's just a little tidbit of information that I'm hoping will get me a couple of points. So there you go.
Well, it got you 1 point, so don't get too carried away. The other thing is, and unfortunately I can't give myself points, but of course GDP is a real measure, not a nominal measure. Of course you've got to bear that in mind when you're looking at the data as well. But anyway, back to the Bank of England. Arno, we're all, I think, in agreement that the risks are firmly tilted towards a dovish decision, whether that is, a 25 bips move instead of the 50 that markets price, or whether that is a 50 basis point hike with pretty firm signalling that we are at or very close to the end of the hiking cycle. I assume this can only be bad news for sterling and see cable and move to the downside, euro sterling move higher, I would assume.
This is where it gets really interesting, because I wish I went first, Adam. Damn it, I totally agree with the 25, by the way.
I'm going to start auctioning off who goes first. I think it could be a nice little side hustle for me.
Like I say, I'll give you my PayPal details after, and if you want to go first next time.
I agree. I think 25 is the market is underpricing the risk of a 25, because I think with what happened with the dissenters, I think their main reason for not voting for a hike wasn't because inflation was still high. It's still high. It was because growth was deteriorating. And even though we're expecting that upgrade, growth still deteriorated. If you look at the PMIs, especially services, looking at retail sales, it's still bleak. So just as a side note, I think 25 is an underappreciated risk. Now, what that means for sterling is pretty interesting, because I think initially whether we get a 50 and a signal that they're going to, slow down or pause, or whether we get a 25, I think initially that's going to see a lot of sterling weakness in the short term because the markets will need to price out a lot of basis points on the back of that. However, there's also medium-term upside risk, I think, and I know that is, against consensus right now for sterling. But if you think about it, over the last couple of months, we haven't really seen sterling react very, let's say, cyclically when it comes to things like inflation data, right? High inflation surprises has actually been sterling negative, while misses in inflation has actually been positive. We've had this market focus shifting from what it means for the Bank of England and how high they're going to go. The focus has more been on what it means for the economy, because obviously the recession risks is there. So interestingly, I think if we do get a monster spike in something like euro sterling, for example, on a dovish surprise, and the ECB comes out and they just give the markets exactly what is expected, I think something like euro sterling shorts could be attractive from a more medium term perspective, because I think a decision to go slower, the markets will look at that and say, okay, a month ago we thought that they would get to this level of restrictive policy. Now it's going to be less restrictive than we thought. Arguably, that's going to be slightly better for the economy instead of worse for the economy. And I think that can actually create some medium-term upside potential.
Look at Arno playing a bit of 4D chess over there.
I was going to say, I think that's a really interesting point, actually. And it is very much kind of against the consensus, which is all very much doom and gloom, UK economy and sterling, which has been the case for quite some time now.
Especially euro sterling as well. I mean, euro sterling, I can't find anybody that's bearish on it. So that's not a reason to be shorted. But if we can see a nice spike higher and the markets, start thinking about what that means for growth, I think that could be
definitely a big fan of fade, like whether or not you want to call it fading consensus or just taking the slimmer trade. But yeah, I agree with Arno completely on that front.
Yeah. So just quickly, but before we move on to the job sprint,
as well,
Brian, I think last week you said, and correct me if I'm wrong, you think the BOE might be one of, if not the first G10 central bank to cut rates as we move into an easing cycle. Is that right? Arno and Ads, I want to ask you the same question. Who do you think will be the first G10 central bank to cut rates later this year or early next?
Well, personally, considering my mortgage is on a BOE tracker, I'd be absolutely delighted if the BOE first, and there'd be clear upside risks to bottomless brunch inflation in London. I think I do think though it will. I do think the BOE, they're one of the first to get started. They're in December of 2021. I think the Feds will kind of look to hold a bit more steady. I think we'll kind of see that reaffirmed this week. I think the ECB, they'll be a bit more premature in terms of the hiking, but I think they'll kind of stay there for a little bit longer. I do think it'll be the BOE that will be first.
I think it's going to be a fight between the Bank of England and the BOC, to be honest. I mean, if things turn out incredibly bad for the housing market, which it looks like it might, they could be first on the trigger. I mean, they were very quick to obviously slow it down. I mean, they got to terminal a lot faster than the rest, but I think BOC is definitely in the runnings for one that could potentially cut sooner as well.
Good stuff. Without further ado then, let's move on to round three. Non-farm payrolls due on Friday. How are we expecting payrolls to impact the policy outlook? I think the market consensus is for a rise of about 185, 190,000 when I looked earlier on. Obviously, we had a sort of Goldilocks situation in the December report where you had a solid pace of jobs growth and average hourly earnings rising by 1/3 of 1% on a monthly basis. So not too hot, not too cold. But obviously, since then, you've had news of layoffs mounting, not just in the tech sector, but in the finance space as well. So where do you think the balance of risks is into this payrolls number? Do you think we're that far away from even a negative payrolls print? Arno, we'll go to you first, as you were complaining you weren't picked first last time.
No, I'm regretting it, you see. No, I think in terms of NFP, well, firstly, we need to see what happens to the Fed, right? If they for some reason come in a lot more dovish than expected, then we know which type of print the market's attention will be focused on. If they come in hawkish, I think either a beat or a miss will be in focus. I think at this stage, we know that the data is leading the Fed and the market as well, for that matter. So it's going to be important. I think from a tradability perspective, what we've been looking at for data points recently out of the United States is looking for the cleanest edge that you can get. So I would really prefer not getting something like a Goldilocks print or a stagflation print or any type of mixed print. I would like to see all red across the board or all green across the board. It's just simpler to trade that way. I think it's going to give a cleaner edge. And the easy play will just be the dollar for that, right? I think if you're looking for a big beat, it's probably going to be dollar upside. A big miss will probably be equity upside, again, depending on what the FOMC says. But again, I think I don't think this is going to be, the jobs print will be important, but I don't think it's going to be a monster game changer. We also need to keep in mind that, if we do get a big miss out of that print, the markets might be able to talk that away, because we had that big miss coming out of the ADP data. And I'm not sure if you guys saw that. And the bulk of the miss was attributed to weather-related downside. So they said that for the reference week, it came in super bad, which is why they only had the 107,000 print that we got. But it was mostly down to weather-related issues in the reference week. So I do think that the one caveat to keep in mind about NFP would be that if it does come in lower, the markets might say, yeah, but it's weather. And obviously that's something we just need to keep in mind. But from a tradable perspective, the cleanest, clearest edge, all green or all red across the screen. Otherwise, I just won't be interested in that one to trade.
Can I add a little counterpoint to that?
Of course you can.
I hate NFP with a absolute passion.
Is that why you hide in the bar at the Stafford every time the payrolls print comes?
Exactly. Why I will be at the Stafford.
I was going to say, I'm surprised you know what it is.
I will be at the Stafford on Friday when it comes out with my glass of red wine and my cigar, and I'll be more happy than anyone else that's trading. NFPs are guesses. No.
Newsquawk playing in the background or not?
Possibly. NFP, it's a complete guess. I genuinely believe that you could know the number now, all the data now, and you would still 50-50 if you do your ass on the day. It's ridiculous. And the thing is as well, the Fed knows how volatile the number is. I don't believe the Fed care as much about NFP as most people make out. There's better metrics to rely on. There's more timely metrics to rely on. We had non-farm payroll. We had the BLS come out, what was it, just over Christmas, and say basically over COVID they miscounted by 2 million or something stupid like that.
It's a rounding error, isn't it?
It's a horrendous data point, and the only reason it's so fixated upon is back in the day during the war. No matter if it was above or below, the bunds and the T notes would trade 2 points or 200 ticks, whatever you want to call it, and stick there. Now it'll go up 100, down 200, up 50. It's honestly, do not believe the hype of NFP. And I'll tell you what, I know you're going to ask me in a minute, but I'll throw you the NFP guess right now. Fish and chip.
Hang on, we'll do that in a second. Go on, Ads.
I would like to push back a little bit. I did see a good point kind of raised by BMO the other day. I think that as inflation gets more on a clear downward trajectory, given the Fed has a dual mandate, I think non-farm payrolls has plenty of potential to become a more tradable event as we kind of go through. I think the immediate non-farm payrolls this Friday won't be, because if it does come in soft, I think you'll get the usual line that you saw from Fed officials themselves, whereby they want to see a string of reports. But I think going forward, at the expense of inflation, you kind of could see a bit more priority put towards non-farm payrolls. But in terms of kind of covering it in the immediacy and kind of market reaction, I think Ryan's right. The price action can be a little bit aggressive. It's worth noting, if you are a retail trader, it is a multifaceted report. It's just not this one headline number. You get the unemployment rate, which is part of a different survey. So sometimes there's data collection differences, which can mean there's a discrepancy between the two. Sometimes the wages can say something different to the headline, and therefore you can kind of get a second move, which is kind of counter to the first one. So I don't think this upcoming report will be too important, but going forward, I think there's a chance they can increasingly more important.
I think that's a really good point. Actually, Citi had a note out the other. I don't want this to turn into let's just share the bank research we've read, but Citi had a note out the other day, and it was S&P 500 forward implied vol by day. And actually, the next payrolls print, which is obviously Friday, the forward implied vol was the same as the next CPI number in, I think, Valentine's Day. What a romantic gift to us all that is. So it is quite clear that the market is going to start paying a bit more attention to it. Adam, I just want to dive into a point you made there. As you say, we've got two surveys that go into the labour market report, the establishment survey and the household survey, and a whole host of data points. If you could only look at one figure as a policymaker or as an economist, what would you say we should really be focusing on? Is it the unemployment rate, the underemployment rate, the headline payrolls print, or something totally different?
I wouldn't necessarily say the unemployment rate, because I think obviously that's people that are actively in the workforce. So as you mentioned in your intro, there's been a lot of layoffs in the finance sector and the tech sector. So assuming they get severance packages, they're not immediately going to necessarily be looking for jobs. So they might not necessarily immediately kind of show up in the data point. I think obviously the headline payrolls is what the market always kind of runs with, and people kind of like to see the trends of that. I think it's sometimes a little bit of a cleaner number, albeit you do kind of get those massive revisions. But I think ultimately it'll be kind of a case of the headline allied with kind of the wage components as well, because ultimately wages are where you're going to see any signs of second round effects of inflation. And that's going to be what the Fed's going to be looking towards as we kind of get towards Q4 of this year, where we're currently potentially pricing some rate cuts. I think if things are a little bit sticky on that front, then I think you see some of those kind of expectations disappointed and possibly push back into Q1 of next year.
I think that's a good shout. So, Ryan, you preempted my question, so I'll let you go first. Consensus is at 185, looking at Bloomberg right now. Give us your payrolls guess. Go on, Ryan. You go.
I just got to consult with Team PIQ's mascot, Nelly the elephant. Hello, yeah. Nelly says fish and chips is the guess, because it's might as well. There's no point guessing a number. Completely random. Fish and chips. Let me guess. Okay.
Right. Arno, go on. What's your guess, mate?
136.
136. Adam?
So I think if you genuinely think you can guess it, you are insane. There's people that pay a lot more and do a lot worse at it. So what I did, I took the range from 125 to 260, I put an online random number generator, and it gave me 249. Also, reassuringly, that is, it says the opposite of ADP as well. So I'm actually quite confident about this one.
I think you've probably got quite a decent chance following that method. Right, in that case, let's move on to the final round. Earnings season is well underway, and I've got some stats for you, because earnings have not been particularly great compared to recent history. I do have to read these because my memory isn't particularly great anymore. So 69% of those companies that reported thus far, I think this was up until Tuesday, have beat analyst expectations. That sounds quite good. But the 5-year average is actually 78%. So compared to that average, things are not going particularly well. And of course, the guidance that has accompanied those earnings has also not been particularly brilliant either. Intel and Microsoft, to name but two, giving rather poor forecasts and guidance for the future, and obviously news of workforce trimming is mounting as well. So with all of this kind of negativity on the financial front in terms of earnings, the market has pretty much shrugged that off so far. The S&P 500 is 6-7% higher year to date, comfortably north of the 200-day moving average, the Nasdaq and the Dow as well. So how long do we think the market can shrug off this disappointment, and does the rally really still have legs? Adam, let's go to you first.
So I'd kind of push back a little bit in terms of disappointment. Obviously, like you said, relative to historic norms, it hasn't been as good. Well, I had a feeling this would be the case. So, with earnings as well, relative to expectations, I think it's always kind of hard to tell how good a beat a company actually is, or whether it's Wall Street just being over generous. I kind of often tend to kind of fall on the latter, as you always see expectations kind of lowered too much in the scenario of kind of a bad event. But in terms of the guidance, obviously there's kind of some top line risks which have been quite thematic throughout earnings season. So we've seen obviously uncertainty over the economic outlook, elevated inflation and tight monetary policy. Although from a broader macro standpoint, I think it's actually been quite a lot of positives. So one of the things you mentioned in your introduction was job reductions. Well, to me as an analyst, that means cost reduction. So potential increase of profitability going forward for some of those companies. We've also seen that supply chain easing. That's been quite a key theme throughout some of the conference calls, which relative to last year is obviously has good positive implications for the US economy and those producers. Potentially, if you do get a pullback in the dollar, that can make things more of a pullback in the dollar can make things more competitive from an export standpoint. And also, of course, the big macro story has been the China reopening as well. So I think there's actually quite a lot of positives. Whether in terms of you can kind of see this sustained or not, I'd like to reserve judgment as we've got some real big tech heavyweights, got like Google, Amazon, etc. to report. So that potentially, if they're on the negative side, we could see a pullback, but I don't think it'll be too much of a sustained move. I think as we go throughout the second part of the year, then central banks kind of take their foot off the gas and we potentially get some rate cuts. I think it's going to be a slightly more positive year than we saw last year.
Well, there we go. You've had the ultra pessimistic and now the slightly more upbeat view. Ryan, which side of that particular fence would you go?
Do you know what? I'll straddle that fence for you. There you go. Sorry.
You've got away with words, haven't you?
There's an image. I agree with both of you.
Can you lose a point for making us think of that image?
I can give you worse images. You've seen worse images. Anyway, we digress. I will split the middle. I see upside and downside. People are harking on about earnings. So I think 61% beating on the EPS. Sounds great, but then when you look back over the past 3-4 years, they've been beaten 70%. So it's kind of more, that's just, how the street kind of just gets it wrong all the time. One thing to kind of always bear in mind is stock markets, equities in particular, like the indexes and stuff, they very much look forward, which is why forward guidance is always such a big deal, as opposed to we focus on earnings misses and stuff. It's all about the earnings. It's all about the forward guidance. Where I will just kind of briefly touch on forward guidance, and again, this is definitely not my forte. What is exactly? The China reopening optimism that kind of keeps coming up is great. And if you believe that, it does seem like they are going to stick with the reopening and stuff. However, it must be noted that China only represents 5% of S&P 500 revenue. Obviously, that's direct revenue, and of course, China is the powerhouse, that drives everything else you can argue. But at the end of the day, revenue of the companies in the S&P 500 rely a lot less on China than what the vast majority of people would have a guess at. But then again, it's not my bag. I'm going to hold my hands up and say, well, what? There you go.
Well, as you said, what is? Arno, where are you thinking in terms of the equity market? And just more broadly, not necessarily in terms of earnings, just equities more broadly. Do you think that? I saw something the other day saying that when we've gained in January, that has a very strong, very very strong hit rate for a gain throughout the rest of the year in terms of Wall Street. Do you think we're on for this bull run to remain pretty prolonged?
I don't think so, no. I mean, I think going into the year, the reason why we've had this type of reaction is because, once again, it's all about expectations, right? Coming into the year, there wasn't one note that I read that said something positive about earnings. Not one. Everything was, earnings is going to be super bad, downgrades, expect heavy bad forward guidance. They just painted this super bleak picture. So for me, going into this specific earnings season, there was always going to be upside risk in equities in the short term because there was just such a
saying that now. Jesus, yeah, cheers, mate.
such a bleak picture painted, right? So if you get earnings that's bad, but it's not terrible, then obviously that's better than expected, right? So I think that is one of the reasons why we've seen this type of reaction. And I think we get the big guns out tomorrow night, right? We get Apple, Amazon, Google. I think once those are out of the way, the focus will turn away from earnings and the focus will turn back to the economy. So there, I think it's once again going to be down to the data. I'm not sure how long this, the soft landing narrative is gonna continue. I mean, a lot of that is based on some of the data we've had. Housing market data has actually started to bounce, and I think the markets will look to latch on to any type of positives they can right now, and that might have a bit of a bounce, but I do think ultimately it still goes lower. So I think for this week, with big earnings still in the mix, I think upside risks will remain, depending on what the earnings does, obviously, and what the Fed says. But I think in the medium term, the focus will, after this week, will turn back to the economy, and that means that the data will once again be the leading driver for equities.
Arno, can I ask? So, soft landing, yes or no?
Well spoken, haven't you?
Well, no, I think it was like a bit of South African was creeping in, like negotiation. Arno, soft landing, yes or no?
No.
Let's finish with that question across the whole panel. I'm in no soft landing.
Adam.
As the saying goes, the soft landing is the economic equivalent of the Yeti. Always talked about, but never seen.
Take a point off.
That was an incredibly long-winded answer, wasn't it? Do you know what? I can't take a point off, because if I did, we'd have a three-way tie, and I don't have a tiebreaker. So he's going to have to keep his points, unfortunately.
You can take a few points off of me.
Ryan, soft landing, yes or no?
Yes. No doubt. No question. No, I don't think it, I think it's, again, any landing you can walk away from, it's a good landing, right? I honestly don't believe the hype again. That's my phrase for today. Soft landing, walk away, lovely jubbly, by the pool, couple of cocktails, happy days.
In that hat, most probably. Well, in that case, time will tell what pans out in terms of whether we get a soft landing, a hard landing, or some sort of crash landing. But let's have a look at the final scores, because that does bring today's show to an end.
Can I just say, I think Arno's been robbed here.
On 13 points, and Adam leading the way on 14. We don't have any stewards' inquiries on this programme. I was told when I signed up to host it that MB is God when it comes to assigning points. So, there you go. Obviously, Adam paid the biggest bribe this week. So congratulations, Ads. Well done for winning.
Thank you. I would say I'd be excited to tell my friends and family, but I'm not too sure they really care too much. But I appreciate the appearance on the show.
Well, thank you, all three of you, for joining us this week. Arno Venter from Financial Source, Ryan Paisey from TIQ Suite, and Nelly the Elephant, of course, and Adam Linton from Newsquawk. Links to all of their websites will be in the description for this video, so do have a look. I can wholeheartedly recommend all three of the services that they provide. It will be very, very well worth your time checking those out. Thank you also to our producer, Kyriakos, without whom none of this would happen. We will all be back next week to go through and digest the fallout from this monster week in financial markets. But for now, thank you very much for watching, and we'll see you again soon. Goodbye for now.